All right, well, good morning, everyone. My name is Mel Montagny, president of Fair Insurance Rates in Monroe, or FIRM, as most of you know us. So on behalf of FIRM and the many property owners, associations, local governments we represent across Monroe County, thank you for joining us this morning for this important session. We are especially grateful to Monroe County staff for hosting us here at the Marathon Government Center, and to each of you, elected officials, senior staff, building department leadership, for making the time to be here. Your presence signals how seriously our communities take the challenges of roof-related non-renewals and the practical impact they have on property owners, the local economy, and our ability to keep people insured in a high wind zone. We are deeply grateful to Citizens Property Insurance Corp. For teaming up with FIRM to put together this town hall. Their willingness to engage directly with our local officials and building professionals is truly appreciated. This morning's conversation is deliberately focused on you, government officials, building professionals who shape local codes, issue permits, conduct inspections, and provide the documentation that directly affects whether property owners can obtain or keep insurance. One of our clearest goals today is to strengthen paths of communication between citizens and Monroe County building officials so we can work more effectively together going forward. This year, FIRM is celebrating 20 years since its founding, formed by a group of neighbors in Key West concerned about the ever-increasing cost of windstorm insurance. FIRM has consistently advocated for fair windstorm and flood insurance rates, educated residents on mitigation and the claims process, and worked to keep coverage available and affordable in the Keys. Over those 2 decades, our efforts with strong support from elected officials and local government staff have delivered meaningful rate protections, higher policy limits, and other practical improvements. Even as the broader property insurance market shows signs of improvement, we in Monroe County have seen this cycle before. Periods of apparent stability have been followed by sudden retrenchment, capacity shortages, and sharp rate increases. That experience is why citizens remain so vital here. We fully understand and respect the need for sound underwriting rules and regulations. At the same time, we cannot lose sight of a fundamental reality in Monroe County. Citizens is not merely a market of last resort. In many cases, it is the only market available for wind coverage. Because of that unique dependence, we need citizens to work even more closely with our community, our building officials, our property owners, and our local governments, so that documentation standards, roof requirements, and non-renewal practices can be applied in ways that are clear, practical, and workable for the Keys. It is my privilege this morning to introduce our guests from Citizens Property Insurance Corp. We are joined by Tim Serio, President, CEO, and Executive Director of Citizens, and by Robert Spotswood, a member of the Citizens Board of Governors and a longtime Keys resident and business leader whose presence on the board has given Monroe County a very important voice. Also with us are Jay Adams, Chief Insurance Officer who oversees claims management, policy services, and catastrophic storm response, and Stephen Mastella, CPCU, Vice President of Underwriting, who leads underwriting strategy and operations with deep expertise in roof evaluation, remaining useful life, and the documentation needed to maintain coverage. Both Jay and Stephen were on the ground during Hurricane Irma. I can personally attest to this, assisting with wind claims, so they know our challenges firsthand. Also joining us today is Erica Poole, a local architect based in Big Pine Key, a valued FIRM board member, and a member of the Florida Keys Contractors Association. Erica brings a unique and highly practical perspective. She lived through Hurricane Irma firsthand, almost at ground zero on Big Pine Key. Drawing on that direct experience, her professional expertise as an architect, and her work with local contractors, she will present specific points of discussion for citizens to carefully review and consider whether adjustments to their remaining useful life rules for roof may be warranted to better reflect real-world conditions in the Florida Keys, as well as provide more detailed information on sealants, roof coatings, manufacturers' warranties, and the specifics of those products. Here's how this morning's session will proceed. We'll have some remarks from Robert Spotswood. We'll have some remarks from Tim Serio. Then the presentation from Jay Adams and Stephen Mastella. And then we'll have a presentation from Erica Poole. Then we'll open up to Q&A, questions and answers after that. Tim, Robert, Jay, Stephen, and Erica, thank you for coming to Marathon and for making yourselves available for a candid, productive discussion. After the presentations, we will have dedicated time for questions and answers so you can engage directly on roof documentation standards, non-renewal practices, permit language, and practical solutions that better serve Monroe County property owners while respecting citizens' underwriting responsibilities, and that help build stronger ongoing communications between citizens and our local building officials. So please join me in welcoming Erica Poole, Tim Serio, Robert Spotswood, Jay Adams, and Stephen Mastella. Robert?
Good morning. It's great to be here, and thank you all for being here. I know this subject is very important to all of us and near and dear to our hearts down here in the Keys. It's something we've talked about, argued about, and fought about, and have suffered through for many, many years. And personally, I've been part of that experience. I was fortunate and privileged to be called by Kathleen Pasadoma, the President of the Senate, back in 2022, and she asked me if I would be willing to serve on the Citizens Property Insurance Board of Governors. Reluctantly, I told her yes, I would. Not my favorite subject in the world, insurance. I find it very complicated, very difficult, and the problems that we were facing seemed impossible to solve. I'd like to thank Tim Serio and his team. These guys have not shied away from taking on any question or challenge that I put in front of them. I feel like over the past several years, 4 years, everything that I've asked, they've been more than willing to dig into with a lot of enthusiasm in trying to solve the issues. And I find that Tim and his team are top notch. I mean, he's really got a really good organization that has acknowledged, not just Tim and his team, but the Board of Governors in general. When I would bring up the Florida Keys in meetings, it's like, well, you know, I said, look, we're the most expensive insurance market in the state. We're the most inaccessible market in the state, and I know it's tough, but we've got to start to figure out solutions. And by and large, I was supported at every step of the way in trying to figure out what to do for the Florida Keys. The Florida Keys, I think everybody acknowledges, is in a little bit different position than most of the rest of the state. You know, we've paid in a whole lot more than we've taken out in damage reimbursements and claims over the years, et cetera. I think there's a lot of misunderstanding of the characteristics of the Keys and the things that mitigate damage down in the Keys. But Tim has really been a good partner with me in trying to find solutions and to figure things out. Tim personally set up through his connections with the Office of Insurance Regulation and president of FIU and others to allow me to sit down with the modelers, and we sat down for hours and asked questions about, you know, the long time ago, following Andrew, the modelers started to look at potential hurricane damage in a different way, and they threw out the history books and they started looking at each year as a brand new opportunity for damage and a brand new chance for storms. And so can't really argue with that. I mean, you know, every year is a brand new year, and just because you didn't have damage last year for the past 5 years, it doesn't mean you're not going to have it this year. And citizens' hands are tied in a number of ways, because the two mandates they have from the state of Florida are to be actuarially sound and to reduce the overall exposure for the state of Florida, the citizens of the state of Florida, and policyholders. And the way they do that is by shedding as many policies as they can every year. I think my first year on, we were over 1,300,000 policies, and this year we're down to less than 300,000 policies.
266,000.
266,000. So certainly we're carrying out the mandates of the state overall, and it's working. I think there's more private market insurers involved in the state, up to 20 or so right now.
20 new.
20 brand new private market insurance companies. Difficulty is Citizens are not required to be the cheapest insurance in the state. So, to be actuarially sound across the state, they set rates to make sure that in a worst case scenario, 100-year storm, that we're never going to have to assess private or assess policyholders and have exposure from major catastrophes to the citizens of the state of Florida. And I think that Tim and his team and Citizens has done a really good job at doing that. I think they acknowledge that Monroe County and the Florida Keys needs special attention. We need to come up with different solutions for us down here because we can't afford ever increasing interest rates. I think that through Tim and his team's work, for the first year for policies beginning in July, you're going to start to see some relief in the Keys, at least with regard to residential policies. I don't think we've figured out a way to do that yet for commercial. But in any event, I think that all of us should be thankful for Tim Serio and his senior team and the entire company for the work that they've done, because I watched it firsthand, and they work as hard as they can all the time to do the best possible job for all of us down here as well as everybody else around the state. I know it doesn't always seem like that because when rates go up every single year, it's difficult to figure out how that's working. I think it's starting to turn. I think things are going to get better, and I'm confident that Tim and his team will continue to do a good job. My term as a member of the Board of Governors expired in July. I think that all of you here, especially those of you in Marathon, will be pleased that President Albritton has appointed Brian Schmidt of Marathon to take my place. And I've talked with Brian quite a bit about the issues and what was going on. Frankly, I was surprised that Brian was willing to take this on. It's not the easiest of positions to get into. There are no easy answers, and it's a lot of work. So I thank Brian very, very much for agreeing to serve. I thank President Albritton for appointing him, and I look forward to the work that he will carry on the Citizens Board of Governors, and look forward to continuing to stay in touch and do anything I can to help this great organization continue to do the best job that it possibly can, especially in its focus on trying to get outside of the box with regard to solutions in the Florida Keys. There are characteristics that we have that other parts of the state don't, that we're looking to take advantage of. And so with that, I'll thank all of you for allowing me to serve this community. I've enjoyed it, and I look forward to Brian's taking over my seat. So with that, I'll say thank you and turn it over to Tim.
Thank you, Robert. I was actually going to ask for a little applause. Yes, Mel. How's this? Okay. And I'm not just saying this because he's here. Robert has been an amazing board member. He's become a personal friend, and he was very difficult. So I just want you guys to know we feigned enthusiasm in attacking the problems, but we did attack them. And he was a great advocate. He was a great board member for the entire state, but he was a great advocate for Monroe County because he balanced the unique needs and challenges of this place with an understanding of the realities of the insurance market and politics. And he always pushed us to think out of the box, because there are a lot of times you can get wrapped around the axle about unique insurance issues and you forget what's the big business picture. Like, business, the private market capital, you can solve other problems. Like you've got to think outside the box. And he encouraged us to do that, and you will be missed. And I've met Brian, Governor Schmidt a handful of times, and I think he's going to push us as well. And that's a good thing. When I became CEO, we came down here and spent some time in the Keys. It's probably, maybe the first time was three and a half years ago. And my whole team, Jay, the whole team, we wanted to focus on Monroe County. Obviously, the entire state was in an insurance crisis, but Monroe County, we did appreciate, at least we began to appreciate the unique problems that you all have here. And we can't always come with great news, but we will always be candid, and we vowed to always be candid and to try and at least come up with some solutions. And I will tell you, what we've seen is that these reforms that were passed by the legislature, you cannot argue, they have worked as far as the insurance company coming back from the brink of disaster, overall rates dropping, new capital coming into the state, and even in Monroe County, I texted my office. I was texting them to get the numbers, but our market share has dropped significantly. There are more companies writing in Monroe County, and I'd love to know if you all are seeing that, or if you've been able to, if you've appreciated that, not in the sense of gratitude, but if you've seen that coming in and you've noticed it. But I think our market I'm going to get the numbers. I'm not going to throw them out there until I get them. But it's dropped dramatically, and I think what you're seeing now is, whether it's because it's the right thing to do or it's good politics, I think you're seeing a shift from, we have got to save the market because rates are going through the roof. Now there's a shift toward affordability, which I think is so important down here. Statewide, what can we do to bring the cost of insurance down? I think the reforms are driving rates down. Again, overall, I know some of you still may be seeing increases, but overall rates are coming down. And the key is, and I don't think this is a partisan issue, people may take issue with it, but the fact is, the biggest reform that has made the most impact is the tort reform element of the insurance reforms. Insurance companies were being sued into oblivion. And when you take out, and litigation costs, just very brief, litigation costs are factored into rates. Miami-Dade County, the hotbed of litigation, had the highest rates. The private market, private capital, even the reinsurers, overseas, have recognized that litigation is down. When you talk about companies investing in areas and taking policies out of citizens, one of the biggest areas for takeouts was Miami-Dade County. And that's because litigation has gone down so dramatically that folks knew insurance companies knew they could charge a cheaper rate, lower rates than had already been approved, and take the policies out. All that is because when you take out the cost of litigation, rates drop. So the more litigation in an area, the more the rates could go. There was the capacity for rates to drop, and private companies would be interested in coming in and taking out the policies. Does that make sense? I don't know if I'm explaining that very well, but the reforms have kind of redefined what the residual market is. We are the residual insurer, or insurer of last resort. Because of that, we're the safety net. We should not be the cheapest. It's not based on low income or affordability, and we want to be affordable, but we are the safety net. We're like, and this is a bad analogy, but like both my daughters were the worst drivers. They couldn't get State Farm anymore, so they had to go to the General, and the General is more expensive because there's more risk. The idea is, and maybe it's not a perfect system, but if you're coming to us, the private market generally is not interested in insuring you. So ideally you're going to pay a little more. And that, to me, it signifies a healthy market. We still want to be there for you. We want to give you good coverage. We might be a little more expensive, but we're going to be there to pay your claim. And that is the residual market. The reforms I think they have redefined what the residual market is. Years ago, like Governor Spotswood said, we were I think that the largest before he got on the board, we were at 1.41 million policies. Way too big. We thought that when the market, quote unquote, recovered, we would get down to, some people, the commissioner said 700,000. My CEO said 600,000. I wanted to be in the low fives. We were at 266,000. That means that because of in my view, because there's the threat of litigation is not what it was, private companies are willing to invest capital. They're basically willing to insure properties that they may not have been interested in insuring previously because it's a more healthy risk. And so that residual market, I believe, has been redefined. I don't know where it's going to land. I think things need to balance out. Maybe our sweet spot is in the 300,000 or 400,000s. Maybe we're artificially low right now. Maybe we're not. It's going to take a couple of years to see. But that's been the impact of the reforms. And I'm hoping, and hopefully after Jay's presentations and info that I can provide, you'll see that Monroe County is benefiting, but there is still work to be done. There's still problems. And Mel has been a great partner. Where's Mel? Mel has been a great partner. I don't know how I don't know how the relationship was before. I think the relationship, but I like to think that an firm has a much better relationship. Whenever we have wanted to come down here, Mel has grabbed the bull by the horns and set up meetings and gotten an agenda and our heads just sort of spinning. We just sort of show up and do what he asks us to do. I have a family reunion planned next week because I love Monroe, or next year. I love Monroe County, and we're going to do it in the Keys. And I'm pretty sure my family's going to get, their itinerary on firm letterhead before they get here. But he has been a great partner, and we don't always agree. We may disagree today on things, but we always can talk, and that's been a great benefit to me. And again, I appreciate y'all letting us come down and chat with you. So.
All right.
This is Jay Adams, everybody.
Yeah. Good morning. Welcome. Again, I like to pile on what Tim was saying. This whole idea about having this town hall came from a conversation that Mel and I were having actually about non-renewing some insurance policies. And the more we had conversations around that, the more we figured out that we believe there's got to be a gap in condo board knowledge versus what is going on with the insurance company. And what I'd like to try to do today is put on a presentation that will help maybe close the gap and maybe help to slow down or stop some of this confusion. So today what we're going to talk about is condo structural compliance, and that really should probably say versus insurability. I'm going to speak to everything that we talk about today based on compliance with roofing. Okay, so the idea is we're going to talk about commercial condominiums and their roof and the ability for them to either get insurance, maintain it, or rehabilitate themselves. So that'll be really the focus of everything I'm going to talk about. So the goal of this presentation is I have three main groups that we want to try to impact here. Obviously, the building owner and association, the agent, and then citizens. And what I would like to close when we get near the end of this presentation is being able to create win-win solutions for all three categories of these groups here, because I think we can absolutely do that as a group. So we'll start out and we'll talk about the Florida condo structural compliance. So in order to look into that, we have to look at Florida Statute 553.899, which is the milestone inspection, and Florida Statute 718.112, and I struggle every time I say this, Structural Integrity Reserve Study. Going forward, I'm going to say SIRS. That is a lot harder to tongue-tie than the other. So why does this matter? What really has created the change in Florida from a compliance perspective? So everybody remember Surfside condo collapsed in South Florida. I believe this happened maybe 4, maybe 5 years back. And ultimately what happened is they had a structural collapse. And in that collapse, it was a disaster. Obviously the building gone and lives gone. So the Florida legislature took a step back and go, we are not going to allow this to happen again in the state. So we're going to create stricter statewide requirements. And they apply to condominiums and co-ops. And they're going to face new regulatory compliance, which are the two statutes we'll speak to. And it also changed the insurance market pressure, right? For the first time in my recollection, and I've been doing this for about 35 years, I don't think there had been a structural failure like this from an insurance perspective. And as I spoke earlier, we're really going to focus on roof condition because that's really the main point of contention of the compliance studies. And then, can I get insurance? Can I maintain insurance? Where am I at with insurance? And what I've tried to do is kind of take a takeaway and put it in the box at the bottom. The real takeaway here is legally compliant does not automatically mean that a building is insurable. And this is the first time that the condo board may go, what does this mean? I can be compliant with everything the state said, and then you got an insurance company going, well, I can't continue to insure you. So we're going to dive a little deeper. What is the governing statute for the milestone inspection? Again, it's Florida Statute 553.899. And what does it do? It applies to condos and cooperatives. It covers buildings that are 3 stories or more with habitational occupancy. And it replaced the old 40-year recertification approach, and it created a brand new framework within the state. And this is part 1 of that framework. It requires inspection by December 31st of the year that the building turns 30 years old. There's also a carve-out in that statute for local authorities in coastal and saltwater environments, which, aka the Keys, in many places in Miami. They can reduce that standard to 25 years. And again, that's up to the local inspectors. And then you have re-inspections every 10 years thereafter. So before, the law was focused on building age. And now the trigger is really the exposure, and it's not just focused on a pure 40 years. So what does the milestone inspection do? Its main focus is life safety and structural condition review. Has to be conducted by a licensed architect or engineer. And there are typically 2 phases. If you're lucky, you only have phase 1. That's a visual inspection by one of these folks. They don't see anything major, and they write a report up, and you're good to go. Phase 2 is if there might be additional testing needed, if they see substantial deterioration. And when they are getting into phase 2, they are really focused on structural soundness of the building, any unsafe conditions. And, when I think about unsafe conditions, a lot of our buildings have balconies, right? And those balconies spall due to the salt water and extreme temperatures and stuff. Eventually, they can create failure points. So they're looking for things like that for unsafe conditions. Any needed repairs. And then the continued safe occupancy, again, that's the life safety piece of it, right? So they're very concerned that we don't want anything that would hurt unit owners and people in the future. So the milestone inspection is really for structural and not anything to do with budgeting, right? I think people get confused between this and the SIRS report. So what does the milestone inspection specifically not do? It does not determine remaining useful life. So RUL means remaining useful life. And I'll go back and forth between those. The milestone inspection report does not require and does not speak to them developing a remaining useful life of the roof. What they're supposed to specifically address is deterioration, damage, dangerous condition, and recommended repairs. And again, this is not a life cycle study. This is what is wrong with the building, what needs to be repaired. Where is roof remaining useful life addressed? That is addressed in the SIRS report. That does not mean that your milestone report won't speak to it, but that's not the governing statute to make those determinations. So the SIRS report is governed by 2 statutes here. You have Florida Statute 718.112, that's specific for condos, and then Florida Statute 719.106 for cooperatives. And the SIRS report is evaluation of major building components. And they're specifically mandated to produce a remaining useful life of the components that they review. And again, we're focused on roof. What is the replacement cost? And replacement cost means the tear out and put back of something new when that asset's life ends. And then whatever reserve funding needs to bring that in line with its remaining useful life, right? So AKA, how much do we set aside on an annual basis? And again, when we talk about this from a roofing perspective, it really requires the inspector to evaluate the roof, state its estimated remaining useful life, determine the replacement costs, and then provide a funding formula to save for that roof replacement. And again, that's key based on their determination of remaining useful life. So what is CSRS designed to do? This is a long-term financial planning tool. So they're going to consume some of the information that came from the milestone, and then they're going to put all these calculations to it. They're going to make sure that they are funding future replacement of critical components of the structure. And there are really four main components that they're focused on. The building envelope, which includes roof covering, right? That's what we're trying to speak to mostly here today. It's also exterior walls, paint, and waterproofing. It's obviously going to look at the structural backbone of the building. So what are the foundation, load-bearing walls, columns, and floor slabs? Life safety. And again, this is the new Florida legislative approach. We got to make sure people are safe. They're looking at fire protection, windows, exterior doors, and balconies. And I mentioned balconies as a potential maintenance issue. Critical utilities such as electrical, plumbing, elevators. And the whole idea is we want legislatively, they want the board not to defer maintenance and just keep kicking the can down the road. And what happens in some of these instances is the association is waiting for an issue to occur that the insurance contract will pick up and cover that really should have been a maintenance issue. So CSRS is fundamentally a budgeting tool and reserve planning for the future. So what is the financial equation? And we talked about estimated remaining useful life. And if you don't hear but 5 things that I say, this is one that I need you to hear. They estimate the remaining useful life, how many years the component can safely function before it has to be replaced. So if we're talking about a roof, what they're saying is, how long can it stay on the roof and keep the rain from coming in? That is their definition of remaining useful life. When we talk about the underwriting or the insurance perspective, we're going to talk about a very different look at what remaining useful life is. Estimated replacement cost, as I said earlier, it's the takeoff and the replacement of all the component parts of a roof. They have to estimate what that cost is. And then they look at an annual funding goal, which is nothing more than a formula that divides that replacement cost minus any savings that they already have by the remaining useful life that they calculate, and then that'll determine how much they need to collect on an annual basis from their unit owners. So now let's compare and contrast milestone and CSRS. And they are 2 different compliance functions, but they do work closely together. So the milestone inspection, safety and structural, where CSRS is focused on reserve funding and planning for the future, making sure that you're not dropping large assessments onto the the unit owner on an annual basis. Milestone is triggered by the building age, and CSRS is by the reserve study requirement. On the milestone side, they're looking for a deterioration in unsafe conditions. CSRS is going to take that and estimate the remaining useful life and the associated replacement costs so they can put it into their funding formula. Milestone is going to focus on occupant safety. CSRS is going to focus on future capital planning, making sure you're ready for those replacements when those assets age out. So the takeaway here, they were created to work together, but they're not interchangeable. You cannot have one without the other. So now we'll start to focus on insurance industry, specifically underwriting within the industry, and why are they different? So insurability is not the same as compliance. Compliance is statute-driven. It tells you exactly what you have to do. Insurance is not in those compliance functions. So insurers evaluate risk, not statutory compliance. And risk meaning, what is the chance we're going to have a loss in the next policy period? Okay? That's very important. So underwriters are going to focus on what's the likelihood of a claim? What is the storm vulnerability? How about any water intrusion and conditions of the critical systems? And again, I'm going to call out, a building might be compliant statutorily, and they could still face a non-renewal or pricing pressures. And the pricing pressures can be increased rate, it can be increased deductible, loss of coverages, all those things, because the risk might be too great for the carriers to be able to take on that particular risk. And again, I think this is where boards get super confused. I got all this state documentation saying we are killing it. We are on target for everything. And then all of a sudden the insurance company issues me a non-renewal, right? How can that happen? Well, let's just keep diving in. So what's the difference between Sears and underwriting?
Jay, can I ask a question? I don't mean to throw. Can a building be non-compliant and still be renewed?
So underwriting is not going to focus purely on the compliancy.
Right.
When we're talking about roof, and we're going to go through the details of what exactly we look at on the underwriting side, the roof could potentially be compliant, and I don't know. That's a tough question. So as I sit here and think about it, if it's a
He's
structural
going to kill
issue,
me, but I thought that was important. That
yeah, I appreciate this. So underwriting is difficult. We have to look at all the situations that are there. It depends on why we're in a non-compliant situation. If we're non-compliant because the building is structurally unsound, we can't write it. If the roof is non-compliant by their standard, we wouldn't be writing it. But there might be some purposes where there was something that we could put together an action plan where we're working together, that we could carry the renewal for another period while they fix whatever's maybe,
Right.
in
That's what I was trying to
need.
get at. Yeah.
Yeah.
Thank you.
Thank you very much for making me look stupid here. So what is the difference between Sears and underwriting? So keep in mind, we're looking at the exact same roof on the same building, but we might have different outcomes. So Sears, long-term financial planning to replace the roof when they believe the asset ends. On the underwriting side, we're looking at near-term policy risk, which means the next renewal, is the roof going to last one more renewal time frame without creating a loss? Sears is really a funding tool. Insurance is looking at a coverage decision tool. So we're going to talk about eligibility. All insurance carriers have eligibility where roof is concerned. And we're looking to see, is it still eligible for us to be able to create coverage for another renewal? Sears is any positive remaining useful life could still support reserve planning. So if they say that there's 3 years of life, that means that board is going to stretch the funding of that replacement cost over a 3-year period. However, when underwriting looks at it, if you have a low remaining useful life, there's going to be pressure to replace the roof now, not 3 years or whatever the Sears report says. Sears is more concerned with an orderly replacement and funding to cover that, where on the underwriting side, we're going to be concerned with immediate loss exposure, right? The next renewal. An easy way to think about this is Sears is saying, how should we fund the replacement of this particular roof? Underwriting is going to say, is that roof going to produce a loss during this policy term? So what creates the roof remaining useful life conflict, and what creates these tensions? So as I mentioned earlier, the milestone report is not specifically supposed to state remaining useful life of the roof. They may comment the roof is worn out or the roof needs replacing. But we've seen milestone reports that actually have a number of RUL years in there. Sears may show a roof with several years of remaining useful life as well. Association may be fully compliant doing their reserves. And then underwriting is going to look at that same roof and go, well, it might be too old, too exposed, or already too close to failure for us to do something with. And then what happens is insurability pressure will happen maybe before the Sears timeline kicks in, meaning we're going to age the asset faster. And again, if you recall, one of the things I said to pay attention to, Sears says, will the roof stay on and prevent water intrusion? Underwriting says, Is that roof going to have a loss in this policy term? And that's where these two conflicts really start to arise. So again, I think a confusion point for the board is they're seeing their Sears report and milestone, they've got all the reserve, they're comfortable on the timeline, they're collecting the right monies, and then we go, in order for this renewal to go through, you're going to need to replace your roof. So again, another conflict. So when insurance companies are looking at roofs, they don't look at roof age alone. We're evaluating against other factors as well. So what is the condition of the roof? And here's an example. And I'll use just a house for an example. It's more relevant. You have a house that has shingles on it, and you have big trees that shade your house. So the Monroe County sun is not eating a hole through your roof on a daily basis, right? Versus you got a house out here that has no shade. Which roof is going to last longer? The one that's shaded, right? So what is the roof condition? What are the conditions that are affecting the aging of the roof? What is the material made of? Some materials last better than others. How well is the roof installed? And here is another piece when you talk about installation. And we're going to bring this up later as an example. When a roof is installed, it has to probably be installed correctly because there should have been a building permit and there should have been a building permit sign-off at completion. But as things age in time, and again, there's an incredible amount of salt air here, right? You have water on all sides. Some of those installation points may be failing and we don't know about it. So the installation quality at near end of life is not what it was at beginning of life. What has been the maintenance history? Have they done anything to try to prolong this roof? We look at local weather risks, and was any roof coatings applied? So we look at really determining our eligibility for coverage limits, the settlement terms, and then how much remaining useful life is involved in that. So what is Florida's underwriting perspective on roofs? Now, I'm talking here about really the Office of Insurance Regulation. So they regulate all admitted insurance carriers in the state, including Citizens. And Florida Statute 627.7011, paragraph 5, specifically restricts automatic adverse action based on roof age. An insurance carrier cannot solely deny your roof based on the age of the roof. So you cannot have a schedule that says when it gets to this point, your roof is done. There has to be other mitigating factors. Now, this is a statute specific to personal lines, meaning homeowner policies. But on the commercial side, we try to follow, and I'm going to speak to Citizens alone, we try to follow the guidance from the legislature for habitational risk because condos are a habitational risk. It's a commercial building, but it's a habitational. All right. Florida, in that same statute, paragraph 6 says specifically it does not apply to anything but a homeowner's policy. But again, we are looking at that as something that we need to make sure that we're not just pinning a number to a roof. We are going to probably require an inspection to come out and look at where the roof is as it begins to get near the end of its eligibility on the rule side. And what we're trying to do is determine if, again, there's enough remaining acceptable condition of the roof for a renewal. And the second thing that I want you to remember, if you don't hear anything else I say today, from underwriting and the insurance industry perspective, an aged roof, even if it's not leaking, so now we're meeting the definition of Sears, it's still there in place, it's not leaking, it does not lack, or it lacks the same wind uplift resistance and structural elasticity as a new roof, which means it does not function at 15 years old at the end of its life like it did in year one of its life. And that is the main difference between underwriting's perspective against looking at Sears. We're not looking at just age, we're looking at how resistant is it to losses. So another thing that you may have heard of is the 5-year pressure point. And this, again, is really a residential thing, but we apply it or consider it when we talk about commercial rules. So if a roof has 5 or more years of remaining useful life, it might support renewability arguments. If it drops below that, you're going to get underwriting pressure to probably replace the roof. Now, this is against our guidelines, and we're going to talk about our guidelines here in a minute. So even if Sears is compliant, a short remaining useful life can trigger the following from the insurance industry. Replace it. That's the only way we're going to offer a renewal. We may just say, you know what, we're not going to do anything. We're just going to non-renew the risk. We may increase your premiums, increase your deductibles. We may take away coverages. There are a lot of different options for us to engage around this 5-year piece. But again, this is a big disconnect between reserve compliance and carrier requirements. Now, part of the reason that Mel and I felt it was important for us to come down and have a conversation is I want to be as transparent with the market as I can be about all things. So I am pulling back the covers and I'm showing you our underwriting rules. All right. And in this rule set, this determines eligibility. Now, every carrier operates in a similar manner. Everybody has eligibility standards. These are citizen specific. I cannot speak to what other carriers are doing other than to say Citizens has the most lenient time frames associated with roof coverings than any carrier in the state. So that would be number 3 that you remember. Okay? We have the broadest standard. All right. So when we talk about roofs, we break them into 2 categories first. So you have roof shape, and that would be a 212 pitch or less, which really means flat roof, which is what is on most of these commercial condo buildings. Or you can have a, we'll call it all other, which is a 312 slope or higher. Within that, we have roof covering types. So when we talk about a flat roof, you could have a built-up 3-ply tar and gravel, modified bitumen, membrane type roof. So our eligibility standard for that is 15 years. If you're in year 15, we need to be thinking replacement of the roof because now we're at the end of our standards. You're going to be hearing from underwriting. Okay, on the all other type, you're going to see shingles. Those are 20 years. Metal roofs are 30 years. And tile is 50 years. Now, the reason that I showed this screen specifically was not just to go through that, is the bullet at the bottom that says exception. I'm going to be transparent about exceptions. So those are the rules. Insurance carriers have the ability to make exceptions if they have it in their rules set. We allow a one-time exception for remaining useful life if we believe it to be greater than 5 years. So if we have a flat roof and you're at year 15, we do an inspection and it comes back and it says you have 5 remaining useful life years, we're likely going to provide you a renewal because everything doesn't age the same. Think about the roof in the shade versus the roof in the sun. Okay, we're taking all of that into consideration. But I want to tell you something else in transparency. Somewhere in year 2 or 3, we're going to go out and re-inspect the roof to revalidate, do we still think there's another 2 or 3 years left? We may start taking action in that time frame. The takeaway really is, once you hit 5 years remaining useful life, you really need to start putting together a plan for replacement and share that with underwriting. And then together you can work out a plan to prevent non-renewals and things in the future. So how does the exception process work? So we're going to go out and do an inspection, as I said. We're going to look for wear and tear, decay, deterioration, declined, defect. We would require acceptable documentation, and that can be completed on our own Citizens Commercial Roof Condition Inspection form, or there can be equivalent documentation provided from a Florida licensed roofing or general contractor. And as I said earlier, Citizens does not accept roof coatings to extend remaining useful life. So you might say, well, what is a roof coating? Well, a roof coating is a protective surface system for roofs. It's usually in the form of some type of liquid applied system, and it's just applied over the membrane that's there. And it is sold to extend the remaining useful life of roofs. From a Sears perspective, probably buy into that agreement. There are some good things about it, though. So it's seamless, it's painted on, it is waterproof, some have UV resistance, and some even have a reflective layer built in. And we see these on a lot of flat and low slope commercial roofs, actually starting to see them on residential homes. And again, in this scenario, I can understand why a board would want to go this route versus a replacement. It doesn't require a building permit. It is seamless in that you're not tearing stuff out and having huge dumpsters and noise. You got a crew that goes up there and they paint this stuff on. So from a standpoint of that, it seems like it's reasonable to go that route. Why don't the insurance industry treat coatings as a new roof? There's lots of underwriting concerns. It does not change those underlying age of the roof system. So point number 2 was, remember, from an underwriting perspective, anything on the roof that is aging out, you are losing wind uplift and structural elasticity. It cannot fix that. That is the concern that underwriting has. That is why, primarily, the industry does not approve the roof coating. You can't change that characteristic. You can't take a 15-year roof, put some coating on it, and make it a 1-year roof. It doesn't require a permit, and it doesn't resolve issues that we may or may not even know exist. There could be wet insulation, deteriorated fasteners. You've heard me say this 3 times now, deteriorated fasteners. If the fastener is starting to fail and the wind blows from one of our afternoon thunderstorms, roof is gone. There could be underlying deck issues, hidden damages. We still have the same wind uplift concern, and there might be ponding issues that it's not going to address. It really is maintenance. It's not structural renewal. Now, I do want to take a side step and take my insurance hat off. So if you put a brand new roof on your house or on your building, and maybe every 3 years from new, you are putting a roof coating on it, does that give you remaining useful life when you get down there? Because, again, it's kind of like the condition, the house in the sun or the house in the shade. If it is doing something, then maybe there's some means that we can say that it has remaining useful life. We're not going to give it life because you've put this coating on it, but it may extend the life because we're looking at all the conditions surrounding the roof, not just the age of the roof.
Jay, let me jump in. So one of the things that Jay said, I just want to make sure, he said this is why the industry doesn't, he didn't say citizens. It is, you guys can correct me if I'm wrong, but our understanding, nobody in the insurance industry accepts these roof coatings as to extend remaining useful life. Is that correct?
That's my understanding as well, yes.
So,
all right. So I've talked about board challenges, and again, I think that's a lot of the reason we're here. When you look at compliance reserves and the insurance perspective, all these things may come at kind of different directions. The milestone report may show no immediate life safety crisis. Sears may already have everything planned out for replacement, including the roof. However, the insurance industry may come back and say, hey, we need faster action. You got to do a roof. And then the boards are forced to look at or balance the legal compliance, which is following the statute. Yeah, go ahead, Mel.
Jay, before we go on, I just want to address the roof coating issue. You and I have actually had this conversation. There are companies out there that are touting these coatings as quote unquote acceptable to citizens. So I think part of what's going on with boards or even homeowners is they're looking at these commercials and like, I'm believing that. I'm going to put this thing on, it's acceptable to citizens. If the citizens considering doing anything to say these coatings are not acceptable citizens, that have not been okayed by citizens, is that those commercials continue to churn on, and people, I guess, are being deceived and thinking, well, this will make me compliant.
So from citizens' perspective, just working with the agents, right? We don't have any broad communication. We don't usually take a public stand on things like that in the marketplace. We would just communicate that through our agent bulletins and individual interactions with the agent on homes or buildings where this may apply. You're welcome.
And thanks, Mel. And in addition to that, we are aware of some companies, primarily in South Florida, that are doing exactly what Mel is saying. And our legal department has been involved contacting them, telling them to stop using Citizens' name in their advertisements for the roof. So we are aware, our legal team is addressing it, and unfortunately they continue to do so, but we will get that addressed.
Thank you, Stephen. All right, so boards, what are they forced to balance? So legal compliance, right? So that's all the statutory stuff. Affordability, and that would be your sewers and stuff, reserving what can we afford to do, on a year-to-year basis, prioritizing it. Reserve funding, the insurability, and then the owner communications. So we as an insurance industry, or we as citizens, are having a hard time getting the boards to really bring these principles together, right? Because they're confusing. How do you communicate this to your owner group, right? If I can't get the board to understand it, how can they communicate and get support of their individual unit owners? So it's really not always a legal problem. It's really a balancing with the insurability. That's really what this is all about. I think it's good to create a best practice for these boards, and I'll say that the statutory guidelines force some of that best practice, right? They outline exactly what's got to happen. But it's important that the boards get all of their reports to tell a consistent story. You don't want, Sears saying you got 50 years and you got a roofer saying you got 3 years, and you got the closer we can get things aligned to send to underwriting, the better. So you can use your engineering documentation for structural damage, deferred maintenance, and plan capital funding. It's important, again, to create a relationship with underwriting, right? So don't hold back your stuff and try to play hide the ball. We're not trying to play hide the ball. The more information you can provide the underwriting group, the better decisions underwriting can make and can help the board plan for what needs to happen. We don't want to wait till the last minute, and I'm going to talk about non-renewals and what's required by law and so forth, and tell you what Citizens does. We don't want to surprise people, because when we surprise people, you're either dropping a huge assessment on folks that can't afford it, they're maybe retired, fixed income, where they're going to come up with enough money to put a roof on. We want to plan for that type of thing over a longer horizon. So give underwriting the current report you have. Show the reserve funding evidence. That is a big key. Showing underwriting what you plan on doing and fixing in the future. Look at the repair plans and the capital improvement schedules. All of those things strengthen that relationship and give underwriting something to stand on to be able to offer renewals. What's required of the carrier to non-renew the policy? So all admitted carriers are regulated by the Office of Insurance Regulation, OIR. Carriers are required to provide at least 120 advance notice, days of a non-renewal. Okay, so statutorily, an insurance company can come to your condo board 120 days in advance of its renewal and say, guess what, we're not renewing you. We don't like your roof condition. It's over. And in 120 days, you're not going to have time to vet out contractors, get funding, and do anything they ask you to do. And what's going to happen on the back end? Probably a lapse in coverage if you don't have some other market alternative. Citizens, what do? We're going to give you at least 12 months advance notice. So we're going to offer you a window of opportunity and say this is your last renewal if you're not willing to do the things that we say that you need to do. We're going to notice the agent. We're going to notice the insured. We're also going to put specific documentation around what has to happen in order for us to offer another renewal. If the association fails to address this time window and lets it go, well, Citizens is going to non-renew the policy, and now they're going to be stuck with a roof. We're the most lenient roof people in the marketplace. You're going to have a roof that Citizens won't insure. How many other carriers are going to insure that? Zero. Now you're facing potential lapse in coverage. And what does that do for people that have mortgages? Right? You don't want to be putting your unit owners in jeopardy of no coverage for the building because we've not really paid attention to what the insurance industry is saying has to happen here. So how to prevent this? If you get our 12-month advance notice, immediately contact your agent. They are your liaison to Citizens. We're going to ask, hey, submit the documentation you have. Let's see the milestone, the SEERs, any engineering reports. Maybe you have a roofing report. Let's see all that. One thing that I will say is don't spend money at this point in time on engineers and whatever to prove a point about roof condition or roof age or remaining useful life. Don't waste your money. Go to underwriting. Let's see what we need, and then we'll advise you what you can do. Many times we're going to order the inspection, and if you ordered it, we might not even use yours. Save that money towards whatever the future plan is going to have to be. And again, the whole idea is we don't want to non-renew you. If you work with me in this 12-month window, what we're going to ask is, and we've made the decision, you have to replace the roof, okay, to stay with Citizens. We're going to ask for a signed contract from a roofer. It needs to show the start, the end date, the scope of the work, what are they going to do. I need a copy of your building permit, the down payment for the work to begin, and we need those repairs to be completed before the next renewal date. If you do that, we're going to offer you a renewal because we already noticed you on what was in deficit that needed to be corrected for the next renewal. If you're compliant, you got insurance. There's no gap. There's no unit owner problems. Everything will go very smoothly. So what happens if you do have a roofer that says, oh yeah, I got 15 years of RUL left or something? I mean, we've seen some crazy numbers. Now we may have the battle of the experts. And again, Sears folks, roofers, they are not looking at it from a risk basis like the insurance industry. They're looking at it with the definition. Point number one, will it stay on the roof and will it prevent water from coming in, and how many years will it do that? We're looking at it, wind uplift, roof elasticity. So the best thing to do is if we are already exceeding those standards in that roof eligibility chart that I showed you, let's get together, work together, and figure out what we can do to make the best possible outcome. If you do face a non-renewal, there are a couple of possible outcomes. One, the association can work with Citizens, as I just spoke to, and if the work is done, you're going to get a renewal. And you're going to get a renewal that doesn't have surcharges or deductible changes or any crazy. You're going to be just like a long-term policyholder, and you're just going to click to the next renewal cycle. If the association doesn't work with Citizens, the non-compliant buildings are going to be non-renewed. And depending on how many there are, the whole policy might be non-renewed. And then the association is going to be left bare. If we get to that point, we created an endorsement 3, maybe 4 years ago because we saw this roof problem becoming a major issue in Florida. It's not just here in Monroe County. This is a big piece of it. But in Florida. So we developed a roof covering loss exclusion endorsement. And I'm going to talk specifically about what that is. We are the only carrier in the market that has that. And again, in sake of transparency, we were trying to look ahead and fill a gap that we knew that was coming. And I'm going to start to talk about what the gap looks like. So our policy system, where all of our renewals and new business and all come into, can only look forward 150 days. And back in June, I said, Stephen, how many non-renewals do we have in Monroe County alone for commercial? And he came back and he said 90. 90. These are residential and commercial. 12 of these are condo associations that have a renewal date this year. And I'm going to end with an example of one that terminated and how deadly all that was. All right. So Tim mentioned depopulation. I want to give you a very high level of what that is and how it works. Any admitted carrier in the state can petition the OIR to say, hey, I want to take policies from citizens. So sometimes we call it takeout, sometimes we call it depopulation. The OIR looks at their financial status because there are 3 requirements they have to meet. They have to have enough capital, enough reserving, and enough reinsurance to take out a book of business from citizens. The reason these carriers want to do that is, especially if it's a new carrier, they want to fund development by having a book of business. Growing an insurance company one policy at a time for a new carrier is really not a great model to bring new carriers into the marketplace. So Tim said 20 new carriers are here. A lot of those have participated in depopulation. Once the OIR says, hey, you can take X amount of policies from citizens, they come to citizens and said, here's our approval. We send them a file, an underwriting file that has all of the risk rating characteristics they need to produce a premium. And what they do is they say, we want this building. Here's the premium we're going to charge. So Citizens sends a letter to that policyholder. We put our renewal premium in it. It has the incumbent carrier that wants to take out their premium. If that premium is within 20% of Citizens, that means that policyholder is going to be non-renewed from Citizens because now they have a market opportunity. They don't have to take this carrier. They can put themselves into the open market and just get quotes from a bunch of people, or they can take this carrier with a known future premium. So with that basic understanding, and that's very high level, I want to talk about what has happened in Monroe County. We're going to start with personal lines. I know we're here to talk about commercial, but there is appetite in the market for takeout. Okay? Now, do you think these houses that were taken out, and these are single-family homes primarily, do you think they had old roofs, old plumbing, old electrical, things that didn't meet underwriting guidelines? No. These are newer homes or rehabilitated homes that meet underwriting eligibility. So now they put themselves on a new plane. So since 2023, we have depopulated 5,800 residential policies. You might be thinking, well, why is that good? That is awesome. It helps reduce our exposure. But guess what? Many of these carriers offer better coverage than Citizens, right? We are statutorily obligated to provide a very basic, I'll call it, policy. They may have enhanced coverages that we can't provide. They probably or maybe have better premiums than we were providing. You heard Tim say, we're not the cheapest on the street, and that's by design. So the message is eligible underwriting properties go in takeouts. So let's look at commercial. The top box is building count, and the bottom box is policy count. And for whatever reason, we have some buildings that stand on their own that are part of a policy, and we have to give it to you both ways so you can understand what's going on. In 2024, since 2024, 687 buildings, 228 policies. Sounds like to me people are writing in Monroe County. Now, I do want to carve out here, this is admitted and surplus lines carriers. So, and again, we offer the most basic commercial forms. If you go somewhere else, chances are, by default, you have a better policy. So this is Monroe County, commercial lines, admitted market only. So if you want to know who writes here, these folks have depopped their business recently. And again, probably met eligibility standards, probably newer roofs. So there are markets when these associations move themselves into, I'll call it an insurable status. So I just want to cover a few key takeaways here. Milestone does not have anything to do with remaining useful life. SEERS is that framework for funding, and they do call out remaining useful life. Insurance underwriting applies as a separate short-term lens. We're focused on risk. Roof eligibility is statewide, it's not just here. Roof coatings may help performance, but it doesn't reset that original age. And then associations must manage compliance and insurability as two separate but related work streams. My presentation is only about half over. So I am going to show this slide now. So I opened with this slide and said I would close with it, and I lied. This is my first close. So any of those that go to church, this is the first closing. So I said I would show where I hope to be three or win-win solutions for all three of the groups. So on the association side, if you have an underwriting compliant roof, I just proved that there are people in the market that will depopulate your business. If you get depopulated, you probably have a better insurance policy. That's a win all day long. Our agents are our most important liaison in this process. They have to connect the association and citizens, right? They are on your side to help you find the best insurance solution. If you're compliant, there might be better solutions than citizens. And that's okay. We're not here to grow business. We're here to try to help customers get business, be as affordable as possible. But when there are better opportunities, we applaud when they leave. And then citizens, if we can help rehabilitate the property, we'll retain it. Why would we let it go, right? It's hard to find good business as citizens. Or you might have other markets to go to from the depopulation perspective. So I do want to spend a few minutes and talk about citizens' roof covering loss exclusion endorsement. We make this as hard as possible so that nobody understands, including me. So how does this endorsement work? And as I told you earlier, we are the only insurance carrier that have this endorsement. We saw this as a coverage gap coming 3 or 4 years ago. We built this as a bridge to help people that get themselves into these situations. So what does it do? It removes coverage for the roof covering of the building or structure identified in our 12-month advance notice. It could apply to a single building or multiple buildings. And I want to give you an example of how this works. Let's say, for example, we have a building that we're going to apply this endorsement to. The value of that building complete is $1 million. We have a replacement cost for the roof that is $100,000. If we're in a situation that you're applying this roof endorsement, we would value your building at $900,000. So we're excluding the roof, so we're not paying the $100,000 replacement of that. And we're going to rate you on $900,000 for the building coverage, not the full $1 million. And that's important. We'll come back to that. We also do an acknowledgement of the policyholder and the agent, and we do that in case there's a claim in the future, making sure everybody's aware. So what's excluded? Loss or damage to the roof itself is excluded. Any ensuing loss or damage that results. And let me give you an example of an ensuing loss that, well, a definition, I guess, example of ensuing loss. And I'm not going to use roof because we've only issued this endorsement one time, and I would not want to give an example of something until we've had a claim and can actually work it through. I'm going to give you a realistic claim for the keys. You have a building insured and we have a hurricane. You get storm surge. And storm surge is the only damage to your commercial building. Is storm surge covered in citizens policy? No. All right. So, denial. Nothing we can do to help you. But overnight, the salt water gets into your electrical system. The power grid comes on in the morning and poof, the building burns to the ground. Is that covered? Yes. That is an ensuing loss. The salt water caused it? Not covered. But a result of the salt water is it created a fire. Fire is covered under our policy. Building's covered. So on the roof, we don't cover any ensuing losses. So if the roof blows off and the water comes in, that would be considered an ensuing loss. So you got to be careful with this endorsement. It applies to interior and exterior building damage and business personal property. And then the additional coverages do not add coverage back. So let's define what the roof is. Shingles, tiles, metal, flat roof materials, slate, whatever the surface is of the roof. It also includes materials to secure the roof surface. Moisture protection, flashing, vent stacks, insulation. and those installation guides that I've talked about throughout all of this. It does not include the underlying decking or support system. So most of these buildings have a concrete roof. If anything happens to the concrete roof, that is not part of the roof. What duties exist after that? So in your policies, you have duties after a loss, and most of them say you need to use reasonable emergency measures to cover additional damage from occurring. If we don't cover the roof, I can't pay reasonable emergency services. However, you have a duty to continue to do those things on your own at your cost, because we're not going to pay for any of the water loss or anything that's coming in the building. That's going to be on you as well.
Jay, let me interrupt. How much longer do you think you have in the presentation?
I have a few more slides here, and then I have an example.
Okay, and then questions.
Yeah.
10 minutes, 5 minutes?
At least 10.
Okay.
So what happens when the roof is replaced? So the policyholder has a duty to notice citizens immediately when it's replaced. And you might ask, well, so I'll go through the slide and I'll go back to my example. If a replacement occurs before policy expiration, premium and applicable deductibles may be adjusted. So here's what this amounts to. When that building is complete and that roof is replaced, you have a duty to notice citizens immediately. And the reason we want to do that is we want to get you back to full coverage as soon as possible. We want to remove that endorsement. We're also going to increase your premium. So we're insuring you for $900. We're now going to go to the full $1 million. That's the full component piece of the building, including the roof. And then you got to pay the additional premium associated with that. When all that's happened, that building is covered just like any other building on the policy, and you're back to full coverage. If you don't provide notice, you could be subject to cancellation, and if you have a claim on that, when the claims adjuster comes out, they're going to see the endorsement and they're going to deny that claim. So I just talked about this. How do you participate in the program? So if you end up in the non-renewal, we've given you the notice and you did nothing during the 12-month period, and you were rolling the dice, maybe we were just kidding, and we cancel that policy, or we non-renew certain items of the buildings. At that point in time, you really should reach out to your insurance agent and see if you qualify. They'll reach out to underwriting, and we will tell you if that's the case. We would need that signed contract, and the same thing we would have needed if you were doing this during the policy term of warning that we talked about, and we will only honor that endorsement up to 12 months. So if you say you're going to do all this work and then it doesn't get done or completed within 12 months, we're going to non-renew a second time, and we're going to be done at that point. So I do have an example that I want to walk through. And this meeting is predicated based on that discussion that Mel and I had on this risk. Now, I'm not going to tell you who the condo association is. It is here in the Keys. And here's a situation where... Well, don't say anything if you know. We don't... Maybe I shouldn't go over this. But I think this... This is not meant as anything negative against that association. Let me step aside and say, I think this board was confused. They had documentation, and we'll walk through that here. They had documentation that said that they didn't need to do anything, and they had insurance companies saying you do. So the core issue here is a coverage gap. We have an 8-building condo. They've been with Citizens since 2009. So the reason I point that out is they had a long relationship with us, right? We've been through this a long time with them. The issue is 5 buildings that lost coverage because their roof ended up with no remaining useful life or a level that underwriting could not offer another renewal cycle for. And this example is great at demonstrating why interim solutions are so important to prevent these types of things from happening. They really took inadequate steps to address a known roof issue, and they faced a market availability problem. So all I really want to point out here is the photos in the left column are from the milestone report. The right column is from a citizen's inspection. And I don't know if you can see this, but if anybody thinks that that roof meets any kind of current eligibility of any insurance company, we probably need to calibrate. So you can see this roof is significantly deteriorated, and they put a roof coating on. So the roof coating, could it in any way take away this wear and tear or problem that was there? Because it was painted on. There's no way. Could it change the elasticity or the wind uplift? The answer is no. So what's the background here? I said they had a long relationship with us. There were 8 buildings. They were built in 1979. We have a roof permit in 2006 where they did prior work on a metal roof. And the only reason I point that out is they have been doing maintenance. They did a roof coating, and they did this maintenance on this roof here. And we see that they put a silicone roof coating on in 2024. The citizens' pictures were to verify that that was done. So again, they've seen confusion with all the reports. They had a Hurricane Irma claim from 2017, roof fasteners. You heard me say, and I've said this probably 3 times, roof fasteners fail over time because they deteriorate, right? And when you're in a salty environment, they deteriorate really fast. Well, that's what happened here. The roof was not a problem during Hurricane Irma, but some of these fasteners were. So they had a milestone inspection report in 24, and it showed deterioration on the roof. You had a Sears inspection, and here makes my point. Sears said there was 23 years remaining useful life of the roof. Who in here believes that that is a possibility on the photo I showed you? Why would they say that? Because they believe the roof will continue to stay on the roof for 23 years and continue to shed water, even though it's peeling and breaking in the seams and all those things. They also had a silicone roof coating applied. So underwriting has continued to try to work with the association. We've tried to be transparent and flexible. In 24, I shouldn't even read this one out loud, underwriting granted an exception that gave them 2 years of remaining useful life based on the roof coating. And how many times have I said the citizens does not accept roof coating? In 2024, this was a newer technology, and nobody really knew. All I'm trying to point out here, it's not about the roof coating. We extended the olive branch every time we could for this association to please put a roof on the building. The association was advised that full roof replacement was required for the 5 buildings in order to get a renewal of June of this year. So they did nothing. The market did not provide alternatives for those 5 non-renewed buildings. We did non-renew them. We kept 3, we non-renewed the rest. The agent approached a dozen primary and surplus lines carriers to no avail. Now, why do you think that was? I showed you there are people that are willing to take depopulation or policies from citizens. If it didn't meet citizen standards, and we were well beyond our standards, and anybody looked at those photos, there's not a carrier out there that's going to write that building. That's what they ran into. You can put it on the Keys, you can put it on the moon, it doesn't matter. Nobody is going to take on risk to have a loss when you know it's going to happen. And at 6/9/26, their renewal date, they had 5 buildings with no coverage. Now, you heard me say earlier, what happens to unit owners that have mortgagees? I don't know. We don't get involved in that. It can't be good, right? It's not good for your association either to have no coverage on your building. What would happen if something caused that building to fail? And all these buildings were multi-million-dollar buildings, right? Are they going to assess the unit owners multi-millions of dollars? They're lucky nothing has happened. So we offered a new solution. It was their endorsement. They did do everything we asked in the time frame that we asked it. And again, I'm going to be transparent. I probably shouldn't say this out loud. In our ability to try to help people, we eliminated their lapse in coverage when they became compliant with this endorsement. Now, they still don't have coverage on those roofs. However, we did not let the gap in coverage stand. We gave them X amount of days to provide this information to be eligible, and we slid it back and provided coverage with the roof exclusion endorsement. So, I'm there. Tim, did you have comment or question that you wanted?
I don't know. I fell asleep about a half hour ago. So, no, Jay, that was a great presentation, and I hope it's, a lot of times we want to be really candid, and sometimes we stick our face in the buzzsaw by doing that. But I really now's the really important part where Jay threw a lot at you, and it was really good and helpful. But we want to answer your questions.
Yes, ma'am. Go ahead.
So I've been a customer of yours for 34 years with all my properties. So thank you, citizens, because you technically, you guys are the only ones who would do it.
We're family.
So there's that, and my great agent Grimmy, of course. So the other thing, I'm in real estate, and I do sell condos. And I know a lot of the rules came into place after that unfortunate incident. So you just showed us the whole roof part, but now all our condos here are like 50 years old. So you're going to really now go around, because I know like Voltage Towers just did their roof, and it was a long process, plus with the permitting, and then you got to wait 45 days, and then, it's just such a long process. So you're going to see more and more of this, because they are older now.
Right.
They're blasting in the sun. The ACs are, can be blown off and rip the roof, right?
Right.
So are the insurance, as maybe Citizen or any insurance, are they going to assist possibly? So now you're asking us to redo these roofs. Are you offering financial assistance? You're offering a year. You're offering advice. These roofs aren't going to last 50 years, obviously. Do you offer any help? Because as these owners who buy these for their retirement, and they don't have $150,000
Right.
assessment money every year, do you offer any help?
The short answer is not financially, right? I think the help is trying to be transparent through the process, wanting to work with the agent, communicating all this information, and trying to find a reasonable timeline that can work. So if we're at 5 years remaining useful life per se, that doesn't mean that we're going to require a roof this particular term. But what we need to do is start working with the association to understand when we're going to do it. And we need to get things moving in place. We've had a lot of folks say, oh yeah, we'll replace the roof next year, and we renew it, and no replacement. And, oh, I meant next year, and we renew it. And they go, well, maybe one more year. And then we have to make hard decisions. So we've tried to build the tool set that we have, give advance notice. We have the roof exclusion endorsement, things along those lines that nobody else is doing, to try to work with and make a reasonable plan with that association. That's the best we have to offer.
Yeah, because they've been paying you insurance, because for someone like me, I'm like, well, I've been paying you insurance for 30 years, I didn't give any help, I've never had a claim. So there's that. But on top of it, I will say, a lot of people are very upset with these reserves, the condo people.
Sure.
They don't understand, but what I want to say to condo people, condo owners, this is actually saving your life.
Absolutely.
It's very important.
Right.
These condos have been let go. These board members for 20 years on the board have not done you any favors by not taking care of the properties. So I just want to let them all know that this is very important. It needs to be done.
Absolutely.
And don't be upset about us. It's just saving your life.
Absolutely.
Jay.
Yes, sir.
So that brings up a question in my mind. If some of these properties you're talking about are replacing a roof or making other improvements to a building, which make it more hardened, safer, using up-to-date technologies, and got a building that's 40 years old, and whether it's replacing a roof or doing something else, which is making that property less vulnerable to storms, is there any mitigating factors that could result, not in direct financial assistance for those improvements, but in reducing premiums going forward?
I'm not the actuary of Citizens. So I do know that the OIR is looking at some different wind mitigation credits and such. Some of that could certainly come into play. I don't know, Stephen, if you know of anything outside of that.
Yeah. No, I was going to. No, that's a great question. And the big thing. Can you hear me? Yeah. The short answer is wind loss mitigation credits. They hardening the windows, the doors. That could help drive down the premiums. But something Jay said early at the very beginning is that it all depends. It all depends on what they're doing, how much they're doing. So I wish I could give you dollars and cents or an approximate value. But if they go down that process, they should possibly see some reduction in their premium. But keep in mind, that's going to be a balance. That would be balanced with maybe the normal increase in the value of the building, which may lower the rate, but may keep the premium close to where it is. So there are a lot of factors that will come into play. But again, the condo working with the agent, working with Citizens or the other carrier, in those discussions, they can sort of get a feel for what is going to be the impact if we do X, Y, and Z.
Yeah, Governor, I think Stephen hit it right there. I think the most important thing is have the association and the agent work with Citizens, because we have obviously rating guides and tables and so forth. We can tell you where you can get the most bang for your buck. And again, the idea is don't go out and just spend money to try to make something happen. The more you get a good relationship with a company to work with them, we can help you partner to do the right things and spend your money where it will make the most difference over the long term.
Just to follow up to
sorry.
that. Just to follow up to that as well, is that it would incent insurers to do the right thing. So instead of waiting until the last year or the useful life is expired, 5 years before, if they have some incentive, like they can apply for these credits and get better rates, we might see people doing more, being more proactive to make these kinds of improvements early on.
Right. Mel.
This is great.
Well, I guess there's two things. One, to address Governor Spotswood, firm has proposed a new mitigation form, which is Monroe County specific, that would actually grant us some additional credits that are not available on the form today. Now, that form has been sent to the OIR. I would like to tell you that is a recent development, but we have been dealing with this form, Joe, how many years? 10 years? Hopefully we're going to get some traction on this form now. But to Mayor Linney's point, she brought up what I think is an incredible idea. There are two vehicles today, My Safe Florida Home and My Safe Florida Condominium, and those are usually funded by the legislature. So I think as Citizens progresses, policy counts continue to drop, but obviously this is going to have to be a legislative move. It's not going to come from Citizens. Citizens continues to sit on a lot of money, right? Because they do have a lot of policyholder surplus. As these laws have gone into effect, that has aided Citizens and have aided new companies coming in, could the possibility exist that legislatively we could get some of that surplus money from Citizens to apply to a My Safe Florida Home or a My Safe Florida Condominium to help people, to help associations offset costs? I think that's a fantastic idea. I think that's something we need to explore, and possibly gather some support that way. I don't know if Tim has an opinion about surplus being rated, but
well, I will say I am always open to ideas, but that idea scares the hell out of me. But I'll tell you why. There may be a reason for it, but we've had more surplus than we have now. A couple of years ago, after Ian, but before the hurricanes in 24, I think we were close to, I think we were in the 6 billion range, but we also had a lot more policies then, right? So we have less policy holders, so that surplus is going to go further that we do have. I think we're 5 billion something in surplus, but we also have 266,000 policies. So that means we have a lot less, probably the premium coming in the door every year is between 80 to 90% decrease of what it was. That is a tremendous reduction in our premium revenue. So if we have a major storm, we're going to have to pay out claims. But, to Mel's point, the truth of the matter is, when you look at the risk of a 1 in 100 year storm and whether or not we would have to levy an assessment, the risk of assessment, it would take a 1 in 330 year storm. I know it's in the 300s. That's pretty cataclysmic. But that's because of our smaller policy count. So I worry about the surplus being rated.
Maybe that wasn't the right.
It was a bad word to use, but I understand what you're saying. Some type of relief, and I said this in my earlier comments. The focus now, Governor Spotswood's hit on it, but the legislature's looking at it. The governor's talked about it. I'm sure the next governor's going to talk about it. It's affordability and how do we, great that the market's recovered, but how do we give relief? That's one way, and there are other legislative ideas that have kicked around. I do not want to get ahead of my board. But, there's been some talk about the requirement if you come to Citizens that you have flood insurance, even if you're not in a flood zone. There's been discussions about relaxing that requirement. So we hear you loud and clear on the need for some type of relief. But, anything where that gets into the surplus of Citizens, it's my knee jerk is that it scares me, but always willing to listen.
Yes, sir.
Jay, I got a comment and then sort of a question. The first one is, unless the roof exclusion endorsement is an end run around mortgage requirements, this feels like a very dodgy product to be selling. If you have a roof loss that's not covered, and then you're not going to cover losses that are subsequent to that, then it feels to me like it's kind of missing the point of having insurance. And the other one I've got, which is a little more sort of central to your argument, is conflict between underwriting and Sears that was illustrated by your rooftop slide there. If the concerns are roof elasticity and uplift, I saw cosmetic pictures on that slide. My eyes aren't that good anymore, but I didn't see damaged roof connections. I didn't see the significant delamination of anything that's not on the top. And so if you're applying a uniform structure, a uniform coating over that, whether it's hydrostock or silicone or something similar, and you're then protecting the foam or what's below that roof and you're preventing flood, what I guess my core question is, if CSRS is saying that roof is good for a while and that it's not going to fly away, and you're saying it might, or it will based on those pictures, are you sending out, they have an engineer or an architect who said something and you have one who says something else?
So we are doing this based on eligibility guidelines and roof conditions, right? And CSRS is not looking at that. CSRS doesn't guarantee the roof's not going to fly off. It just says under the current conditions, it'll continue to operate, right, as a roof. So if I go back to that chart where we looked at the underwriting eligibility standards, if the roof has gotten to its age, and a flat roof would be 15, now we're going and looking at the other details from the roof. We don't know how well it's still attached and all these other things. But what we're looking for is something to return it to a condition within the 15 years. And there's no way to do that to a roof that's already aged out. And where I'm going with that is our biggest concern for the roof is going to be wind, right? And if it doesn't have the same wind uplift and elasticity, it is not going to be able to maintain itself on the roof. And when I say us, I'm talking about the insurance industry. I'm not talking about Citizen specific. And, to your first question about the roof exclusion endorsement, We have the same concerns. However, we're still offering wind coverage to the building. If we have a storm and windows and doors are gone, and then, any damage associated with that, that is still covered. So I personally don't know what the mortgagee does when a building goes under a gap or a lapse of coverage. Right? We don't get engaged at that level. But we're offering something that nobody else can do to try to fill that gap.
Given your age guideline and the recognition that we can't, or it's too difficult to check connections, aren't you then using an age designation? And as you point out, the industry, and particularly the reinsurance guys, absolutely love this. If they've got a basket of stuff that's 15 years or newer, as Mr. Serial was pointing out, they'll take those in a heartbeat.
Right.
And so aren't you effectively doing the same thing that you're saying there is an age number? And so this roof, if it's over 15, you need to have some sort of extraordinary reason and when we may extend you for a year or more, as opposed to that this roof might really be good for a while long.
So the age of the roof is the beginning of the eligibility issues that we see, right? So we're going to start looking at that roof when it's getting close to that 15-year-old to try to assess what risk it has. And then we apply the roof conditions specific and individually to that roof to make the underwriting decision. Are we going to give it additional remaining useful life, or are we going to call it now?
It can't be, the roof age can't be the sole reason, it's just
Right.
the beginning of the analysis, right?
Yeah, it's the eligibility rule in our underwriting guidelines, in the industry for that matter. Stephen, did you want to comment?
No, Tim, still.
Okay. Okay, go ahead.
So, of course, you're talking about the roof, but of course the collapse was, I think, underneath.
Your microphone, we can hear.
Oh, I'm sorry.
Wow.
I haven't talked about it. All right.
Of course, this is, hi, good, hello, can you hear me now? Hi, thanks, Mike. So, we talked about the roofs, but that collapse in Miami was, I believe, underneath, like beaming and,
Yep.
and structural. So here you're coming in with the roofs, and I know they're gonna pass the Sears and the,
Milestone?
thank you. I should know this since I sell condos. But what about the structural stuff now? I'm talking all these condos down here in the Keys are 50
Right.
years old, average. I know some were built on Cap Rock and the islands. So what about those?
So-
if they pass if they just pass, I mean, what if you say, oh, it's starting to look like it's got cracks because we have spalling? Is that another issue you're going to give us a year maybe?
So we do inspections of our commercial buildings. We also are requesting the Milestone and the SERS inspection on renewals as buildings are starting to get older. I focused this presentation primarily on roofs because of the 90 non-renewals set up for Monroe County, they're all roof issues, right? So we would not write a building that was having structural issues. We would non-renew it if they didn't have it fixed or shored up or, some temporary fix during the period.
Just sort of the age raging out.
Right. It's a good question.
All of us.
Yeah, for sure. Anything else? All right, I'm going to turn it back over to Mel.
Jay, thanks again. Tim, is this on? Can you hear me? I think what we're going to do, we're going to take like a 5-minute break between presentations. Erica's coming up next with her presentation, so if you could take 5 or 10 minutes, get something to drink, use the restroom, and please reconvene in about 10 minutes. Thank you.
Hi, everybody. My name is Erica Poole. I am a local architect out of Big Pine Key, and I'm also the secretary of Fair Insurance Rates Monroe. For starters, I'd like to thank everyone from Citizens for taking the trip and coming here and answering everyone's questions, and for Jay creating a 2-hour that I have to follow up with. I will not be anywhere near that. Clicker? No. Okay. All right. Monroe County is a very unique county. We are a linear county. We are one road in, one road out, and geographically we are faced with a lot of challenges when it comes to construction cost, availability of services, and things like that. Citizens was created initially as an insurer of last resort, and Monroe County took on a lot of policies for Monroe County, as we did not have the widespread private market options that mainland Florida has. Monroe County has some of the strongest codes in the state. One of the initials was since 1983, we've had our 180 mile an hour wind speed requirement for structural engineering design. In the 1980s, we adopted the South Florida Building Code, and post 1992 Hurricane Andrew, stricter standards were created in 1993 and 1994. And those were also adopted down here as well, as in Miami-Dade and Broward and some other counties. Monroe County building and planning codes within all 6 of our local jurisdictions were set up with our unique risks and geography in mind. All components and cladding have to meet NOA requirements for 180 miles an hour and engineered accordingly. This also comes into play with our 50% rule, which is something that is very strict down here and gets triggered a lot more often due to our high construction costs as well. The 50% rule basically states that anything work-wise that you are doing, if it's over 50% the value of the house, it has to be brought up to code. There's also other implications with the 50% rule with FEMA and all of that. And the 50% rule can be triggered in certain circumstances with just re-roof and some other minor work. Statewide standard underwriting does not credit Monroe County as much for our strong wind resistant code and our HVAC equivalency. Despite not being a part of the HVAC zone, we have HVAC equivalent codes down here in all of our local jurisdictions. And we do not permit re-roofing down here with substandard materials. We're requiring secondary waterproofing in certain circumstances depending on the construction cost. We're looking at the clips and the straps and all of that, as well as the sheathing. The standard warranties for like a standing seam metal roof or a 5 feet crimp metal roof, the paint finish is around 50 years, and it can get even greater if you go with certain coatings like Kynar. And the metal itself is 40 years. Tile roofs range from 30 to 75 years. Membranes 20 to 30, coatings up to 25, recoats anywhere between 5 and 10. And with our strict 50% rule, substantial improvement documentation is required, and that applies to all homes built after, I think it's December 31st, 1974. And then Hurricane Irma happened 2017, and our shingle roof stock, our vinyl siding, vinyl soffits, a lot of that disappeared, and everything had to go back up to new code. We ran into the increased cost of code compliance with policies as well. I personally had to get letters from the building official at the time to prove that we couldn't go back with vinyl soffits, and it had to go back to hardy or a stronger material. Any re-roofing had to go to metal or tile or anything that had an NOA that met the 180 mile an hour wind speed requirement. And our building stock has gotten significantly stronger since Hurricane Irma. We have seen an uptick in roof-related non-renewal letters, despite having engineering letters and reports, manufacturer material testings, standards, and warranties. An example that I just heard of today is Habitat was, or actually I'll go into that later. And then due to the insurance deductible of 5 to 10%, the roof doesn't always trigger a insurance payout. Due to our unique geography as a linear county, one road in, one road out, it makes our material costs and our construction costs significantly greater than mainland Florida. I believe a couple of quotes that I got from mainland were about a quarter of the price for re-roof than it is here. That's due to the trucks and everyone having to come in and having to leave. We also have less contractor availability in general in order to get work done. One of the things that this will end up creating an issue with is only having that 1 year notice for a re-roof. We believe that it should be a greater one for us due to our lack of availability. These are our key asks. We would like to pause roof-related non-renewals and grant and reinstatements where possible, and allowing a 24 to 36-month extension when a roof inspection, signed contract, and credible timeline is provided, again, due to our construction costs, our availability of contractors as well. We have a unique situation down here. Recognize Monroe County's contractor shortage, limited private market options, and apply a more flexible county-specific approach with citizens' own underwriting. I want to touch on another point as well, where you're seeing a lot of these takeouts happening within Monroe County, but we're also seeing a lot of negative impact with that as well. I was made aware of Habitat in 2021. 5 Habitats were part of a takeout with another company, Mason, and the next year Mason dropped them, and citizens had to rewrite the policy with a totally new premium. So and Habitat being affordable housing, that's very difficult on their bottom line as well. That's also happening with takeout policies throughout the county, where they're either increasing greatly or dropping, or we're seeing a lot of that. So some of it tends to be people are afraid of the takeout, and I think that's something to consider as well. And that was my 5-minute presentation.
Erica, thank you so very much. I realize she is very nervous, so please, thanks, Erica. Thank you. Does anyone have questions for Erica?
Or for citizens?
Yeah. Well, yes?
I think it's IBHS. I can't remember what it stands for, but it's the insurance or business.
I can't hear you.
IBHS. They have a standard, the fortified roofs. Have you heard of fortified certifications? Other states have adopted that, and that's and I think insurance carriers have accepted that as a standard that an independent inspector, if they are part of that process, then it can create some reductions. Is that something that the state has looked at, or are you got a firm or citizens? Are you aware of that? Is that something that would be beneficial for the state, or even if it's not a state standard, if we just adopted those and used those fortified standards and had them inspected? I don't know if there's enough inspectors to go around those. I think is the shortage in the thing.
Yeah. I'm aware of IBHS and the fortified homes requirements. As you know, Alabama is a big state, and Georgia and some other states. I believe it has been presented in Tallahassee to individuals in government, but I don't know to what extent or if that's something that's on their horizon. But I do know that the state is aware of it. I'm just not aware of any action, any movement taking place with it in terms of fortified homes being a part of it here in Florida.
Erica, can you put up the last slide?
Yeah.
We can make this available to anyone, this presentation.
This is more of a question for citizens and about these key asks. What are the main obstacles for not being able to grant some of these key asks, especially like the 24 to 36 month extension for the roof inspection? And, you know, obviously we've been working on, you know, getting a different mitigation form for roofs in Monroe County. But what are those obstacles that prevent citizens from being able to do that?
Okay, so if it's a non-renewal that's based on the 15 years we talked about, if it's a flat roof, we do give 24, maybe even 36-month advance notice to the agent and to the policyholder that, you know, your roof is approaching the 15 age threshold. Just want to let you know that in few terms your policy will be non-renewed if we don't receive evidence the roof has been replaced. So we do give plenty of advance notice, you know, to those interested parties that this has kicked up 15 years. We need proof that the roof has been replaced.
Hi, I'm Deb Gillis. Related to the key asks, it's similar to what he was just saying is how is citizens recepting any of this? Are you having full conversations with them about any and all of the items that you have on your list?
Yes, we're having conversations.
Okay, and how is that going? Sorry.
They're here.
Okay, Ron Wampler, Key West. Considering House Bill 803 and the introduction of manufactured homes, which we sometimes call mobile homes, what's the insurance policies on those roofs? Because my past history with them is they're not really as substantially built as a standard construction roof. And my concern would be long term, what are we looking at as far as insurance? And does Citizens even insure manufactured homes? Do you insure manufactured homes?
We do insure manufactured homes, and we do monitor the roofs. I'm not familiar with the bill you mentioned, 1803 or 803.
803, House Bill 803.
Okay, I'm going to have to look that up, to be honest with you. I'm not familiar with it.
Florida statute just started July 1st.
Okay. And can you explain to me, what did it speak to in terms of mobile homes? I'm just not familiar with it, and I apologize.
Well, it basically says that local zoning regulations and restrictions are not valid as far as unequal treatment of manufactured homes coming into the area versus stick-built homes on the site.
I do remember that. Okay. Yeah. We do, again, hold manufactured homes to the same roof requirements we do for stick-built. We do actually have a program, an underwriting field survey program, to where we do look at mobile homes or looking at more mobile homes. We do use some AI, artificial intelligence type technology that will give aerial images of the roofs of the mobile homes. So we do hold them to the same standard that we do as a stick build. But I also think your comment was the manufactured homes roofs may not be as good as the stick build. Yeah.
So let me just add to that. So there's a difference between a manufactured home and a mobile home, right? A mobile home carries a title like a car, and it's built on some type of chassis that they can connect to a truck and drag to the location. A manufactured home comes in on a flatbed truck and is boomed onto a foundation. And those manufactured homes are built like on tables, where they're square, they're plumb, they got good nailers in them. I don't think that's a substandard built home. And I think what that bill is trying to do is make sure that the local municipalities are not treating those homes differently. And once that home is put together on a solid foundation, then Citizens would consider it a homeowner policy. And we would treat it like any other homeowner policy. We would not distinguish that as a manufactured home versus a site-built home.
And I'm assuming they would have to meet the Florida building code in order to be.
Well, my comment, there's some confusion in this. It's been created. Is this thing on?
Yeah.
It's been created by the mobile home, manufactured home industry to cause some confusion between what is a modular unit that's built to building code standards off-site,
right?
And then it's a modular home. That is not the same as a manufactured home, which is just a glossy title for the same product, not the same, but the mobile home product that, we're not supposed to use the term mobile home anymore, to tell you the truth. We're all supposed to be using the term manufactured homes. But they do come in on a frame,
right.
On wheels, and they can be set on some sort of foundation, and anchoring is required. They're governed by the Department of Motor Vehicles, which is a different situation than the Florida Building Code. And there's some differences, and they have to be delivered and set up by a licensed manufactured home delivery.
I guess one thing that I do want to get back to, and that was what Erica talked about and what Chris has talked about, is this issue with specifically for Habitat homes being depopped from Citizens with XYZ carrier. The following year they get dropped because of reinsurance structure, risk mitigation, whatever that is. So they've got to get back to Citizens. And Chris, what was your, hold on. Maybe Chris can explain it better than I can.
Basically, it was that when they, after the year that they are dropped, they go back to Citizens, then they're written as a brand new policy. And so the increase is dramatic from the year before when they were with Citizens.
Chris, that shouldn't be happening. So we usually white glove these back in when it happens, and we do monitor the rate overall statewide, not specific to Monroe, but usually the rate of policies coming back into Citizens, it's just below 2%. We expect that to come up as the market sort of stabilizes, and if rates go up in other areas, we expect we're going to see an uptick in that. Again, reasonable minds differ. We think we might be a little artificially small. We think we're going to start to grow again and stabilize. But we should be, if it's the first renewal, we should be able to white glove these policies right back in. Have you had any specific within the last year where folks have been dropped and they've come back?
Not yet. So
okay.
we just started.
I would be surprised if you did.
Yeah. Well, and Southern Oak is now so this was the one, sadly I didn't know that we could white glove it because that was 2021. So they came back to Citizens at this new rate.
Yeah.
And now some are being depopped to Southern Oak, and if next year's renewal, they get dropped.
It is certainly not outside the realm of possibility that they're going to get a rate increase. I mean, I'm not saying they will, but I could conceive of a scenario where there is a rate increase and, it's 18%, right? So you're still within that 20%. But keep in mind, where rates have gone down, you may be eligible to come back in. It may be outside that 20% guideline, even if it's year 2 or 3. But definitely you have my number. Mel has my number. I'll give you my cell. Call me when that happens, but I really think, at least so far, you shouldn't be seeing that. And if it's at the first renewal, we can, I say white glove, but we can expedite the process for getting these, especially for Habitat, getting these back into Citizens. Frankly, we do it for anybody if it's within that first year. Right, it shouldn't be happening.
Or if it's not rate driven, if it's underwriting criteria driven by the depop, we have seen that as well, where they'll come in and say
they take it, but then it doesn't meet their underwriting guidelines.
Well, at the renewal.
Yeah. We can work with you, but if it doesn't meet, their underwriting guidelines, it still may meet ours. Have you all talked about the key asks yet? Have you? I know. Okay. Because you and I talked about these already, and I want to make sure everybody's clear. I don't know what the team said, but we will work with you guys. But it needs to be a case-by-case basis, right? I I get very uncomfortable with a blanket, yeah, we're gonna pause all roof-related renewals. But we will, but bullet points, 1, 2, 3, 4, we will work with you on all of them.
And you have.
Yes, well, thank you, I appreciate that. We will. I would defer to Stephen, but having a specific county, like a Monroe County underwriting guideline, I don't see how we could do that.
I think we're working on that through the mitigation form.
Yes, yes.
How we're trying to address that. But to get back to the habitat stuff, Chris, Scott, if you guys have specific cases like that and you want to use firm as a conduit so you're not hitting them up with each individual, we'll be happy to work with you all and make it easier to work with citizens on those cases.
Mel, can I just add some clarity to your question? So we have a program set up, like Tim said. They should come in and they should be treated more like a renewal than a brand new green new business. It's how they come in. So Habitat for Monroe County needs to be the named insured for the location. And when it comes in, it's going to go through that process. If you write it in my name and Habitat is like a mortgagee or an additional insured, that's not going to get caught through the system automatically.
So would our agent be the person that should
Yeah.
be, because that's sadly our agent said there's nothing we can do. Like that's that part where we have an agent, we don't know we can call Citizens. And so we have the agent and when this happened, they're like, sorry, this is just how it rolls. Yeah. So the agent wasn't any help to us to say, oh, wait, you were just depopulated last year. Let's go and see if we can green light it in. So the agent's not doing justice on that.
Stephen's phone number is 904.
You kind of stole my thunder, but I'm serious. I'm going to give you my number. This isn't televised, right? It's just recorded.
I think it is. Don't do it.
Oh, that's all right. Never mind. I'll tell you what, when we're not being televised, I will give you my number. But if you are watching on television, contact Citizens if you have questions, because we will definitely try and work with you. But I'll give you guys my cell number.
And I do have it, so if he doesn't give it to you, you can ask me.
Mel called my bluff.
And if I could, one more question. Just you've been wonderful with the flood. I won't call it carve out. I don't like to say that, but we've always been talking about the flood requirement with Citizens, and you've been, I guess, working on that. And I thank you. Any update on how that's going?
Well, there have been discussions. I can't get ahead of my board on policy decisions, but we have actually looked at, well, what is the impact of the requirement when you come into Citizens that you must have flood insurance? If that went away, what would that look like? And I think that is a policy decision that I would not be surprised if this legislative session, somebody floats the idea of repealing the flood requirement. And I probably shouldn't say any more than that. Maybe Jim Mooney.
As an update, 2 years it's been on my desk waiting to be heard.
Yeah.
So we're going to continue that battle.
Yeah, thank you. And I think the other chamber, there's some folks kicking it around as well, Representative.
So just tagging on to that is Habitat, of course, is a name, but there's also a lot of deed restricted things that's happening too that's not under the umbrella of Habitat. Is it gets depopulated, and then when they figure out how to get back, and so the insurances just jump.
Right.
So I don't know how we fix that on that side because they don't have an agency that they're running through.
Right.
And those people don't know all that. So this might sound like it doesn't work sometimes.
Yeah.
So
I mean.
It's and I don't think it's probably going on just in Monroe County. I think it's probably going on across the state.
So that's a good point. Any time you've got to have an agent that's on the ball, right? The agent has to be primarily responsible, but whether it's Habitat for Humanity or just a private policyholder in the Panhandle, we will, if it's within that first year, we do what we can to expedite the process back into Citizens. If it's beyond the first year, usually it's considered a new application, right? But again, with the rates, I have seen some scenarios where I don't know why, and I won't mention the insurance company, but a former policyholder got a huge rate increase. It was not the first renewal, it was the second, and they had to be treated as a new application, but because of the rate decreases that have gone on, they were outside the 20%, and they were eligible to come back into Citizens because it was no longer within that 20%. I don't know why the insurance company decided to raise the rates as much as they did, but yeah. You said it, I didn't, but you're right.
Any other questions or anything? I just want to take this moment and say thank you to all of our elected officials, our building officials, folks from the chamber. I can't thank you enough for being here, for having this interaction with citizens. I have to definitely thank the folks at Citizens. This is definitely not their normal stuff that they do, but I think that Monroe County holds a special place in their heart. Maybe that's firms doing, but
it's always firms doing, Mel. You know that.
But again, thank you all very much. We have some sandwiches in the back for those of you that want to have lunch with us. You're more than welcome. There are drinks in the little kitchen area. Please feel free to help yourselves. And again, thank you so very much for attending this morning, for the interaction, and everything else. Thank you.